While we're waiting for a few more folks to join today, I wanted to welcome you guys and for attending the first of our 3 sessions in our financial series. My name is Debbie Johnson, and I am your co-moderator this evening, and I'm from the Johns Hopkins Federal Credit Union. I just wanted to give you a little bit of background on these sessions. We are going to have 3 concurrent sessions each Wednesday over the next 3 weeks. And I was actually approached by the Postdoctoral Association as well as some other graduate and postgraduate groups that is kind of asking the Johns Hopkins Federal Credit Union for resources on the topics that we're going to be discussing over the next 3 Wednesdays. So today's session is on managing investments. And as a grad student, also as a postdoctoral student, PhDs, I think we have them in the house as well. You're going to get a lot of information from our speaker today. We are going to build in some time at the end of the presentation for a Q&A. So it's scheduled from 5 to 6:15 and then 6:15 to 6:30 for a Q&A as well. But with that being said, I wanted to introduce you to our speaker, Mr. Shahar Ziv. I got his last name right. And Shahar is an experienced educator, writer, and has vast experience teaching personal finance at some of the leading universities in the US. And over the past year, Shahar has worked in conjunction with the Johns Hopkins Federal Credit Union and the JHU Office of Student Accounts to share his financial expertise to JHU undergrads. And we are so pleased and honored to have him speak to our distinguished audience today. So without further ado, take it away, Shahar.
All right. Thanks, Debbie, and hi, everyone. Thank you for taking time out of what I know is a very busy schedule to come today. Really appreciate it. Just as housekeeping, I know Debbie mentioned we'll go for about an hour and 15 minutes and then leave about 15 minutes at the end for Q&A. I do like to try to answer questions as they come in as well. So you'll see there is a Q&A button as part of the webinar, and you should feel free to ask questions. I'll try to address as many of them as I can while we're going through. Some of them I may punt towards the end, but I'll do my best to kind of address them as they come in. So, I think as Debbie mentioned, this is the first of 3 sessions we're going to do. Today's focused on investing. We'll have the next one really focusing on retirement. And the third one will be tax strategies, which especially for grad students, PhD students, or postdocs is more complicated than it is for a lot of others. The reason we're starting with investing, when you survey graduate students, investing is the #1 topic that's in demand. You'll see that the other topics we're covering, whether it's taxes and retirement, are also there, but this is one that is top of mind for everybody. Just to set expectations up front, some of you may know this person on the left, Warren Buffett, or Mellody Hobson on the right. I cannot turn you into either of them in the kind of 90 minutes we have together, just not possible. Really what I want to do though is to start to build your investing toolkit. I'll cover some facts, but really focus in on insights and strategies that will start to set you up for both short and long-term financial success. Things like, how do you even think about investing? What are all the terms people are using? Where do you open an account? Should you go it alone or not? How do you build a portfolio? But we'll basically scratch the surface on some of these. We could do an entire day or an entire week, or frankly, you could do an entire dissertation on some of these topics. So first thing I would like to talk about is why should you listen to me? So I'm really, really passionate about financial education. I've done it for over 10 years. I co-founded a course at Harvard for undergrads in 2011 that I've been going back to teach every year. And since then have expanded and taught a lot of other institutions, including Johns Hopkins. Specifically, I've also had the opportunity to work with a lot of graduate students. I do, for the past 6 years, I've done sessions at Columbia for the Graduate School of Arts and Sciences, which is all master's and PhD students. So I understand some of the concerns and some of the topics that are top of mind for many of you. Also, I can relate to a lot of you in a different way, which is, I moved to the US when I was 3, but I grew up in an academic family. My dad has his PhD, he's a professor. I grew up in kind of that academic family, so can relate on more than one dimension, if you will. Most importantly, though, I think is the bottom. I am as objective as it's going to come when it comes to the topic. I am not trying to solicit you to manage your investments. I can't do your taxes. I am not going to make any recommendations for a product or service for which I receive compensation for. So in other words, I don't have any conflicts of interest, and I am as unbiased as you are going to get. And to me, that's the number one rule and number one lesson I often impart on people when I'm talking about personal finance. You always have to ask, why should I listen to this person and what's in it for them? In this case, I've had the privilege of partnering with the Johns Hopkins Federal Credit Union to kind of bring these sessions to you. But when it comes to financial advice, a lot of people are going to have your best interest at heart, but a lot of people are also not going to. And it's really important to try to distinguish the two and really understand, does this person have a conflict of interest, and is the information they're giving me in my best interest, or is it in their best interest? So I always like to start with that as kind of the first lesson. So with that, let me get started. And let me just start with the secret to investing. Very, very simple. Well, I'll tell you what it's not, which is it's not invest everything in GameStop. If any of you have been following, kind of the news in the last, 6 months or so, you've seen a lot of these meme stocks pop up. Some people have gotten very, very rich, but a disproportionate number have lost a lot of money by this. The secret to investing is actually quite different, and probably the most counterintuitive thing that many of you have heard. The secret to investing is actually to be average. Now, look, you did not get to where you are today by following this mantra. Your parents probably never said to you, aim for mediocrity. And this is the most counterintuitive thing that you've heard. If anything, you've gotten to where you are today by aiming to be above average and well above average. The paradox when it comes to investing is that by aiming for average, you often end up above average. And let me prove that to you with kind of a great anecdote. So we talked about Warren Buffett. Warren Buffett is king of the average investments. What he espouses to pretty much every American is buy average funds. And what he means by that is low cost, passive index funds that all they do is track the market. And he basically said, I am so confident in this that I'll put up $1 million of my money that my average vanilla and index funds can beat any investments that somebody else wants to put up. Protege Partners, which is a hedge fund, actually took him up on this. The beauty is, it was a win-win. All the money went to charity. But let me ask as a poll, and I'm sure kind of a leading question, but let me ask this. Who do you think won the bet over a kind of a 10-year span, Warren Buffett or Protege Partners, in terms of kind of the return on their investment? Who do you think won? Give it a couple seconds. All right. Well, I probably led the way for a lot of you. Some of you are still skeptical. 4 people think that Protege Partners won. 29 think that Warren Buffett won. So pretty good. Well, I probably, asked more of a leading question, but the answer was Warren Buffett by a landslide. This is from back in 2017. Warren Buffett had a kind of a total return of about 125% from his investments. Protege invested in 5 different funds, and you see that their average return was about 36%. So not quite, a 4x return for Buffett, but pretty close. And what's funny to me is that you look at the funds that Protege invested in, none of them actually came close to beating it. And obviously, the weighted average would be lower. But you can see that some of them returned 87%, some of them only 2.8%. So again, aiming for average actually gets you to be above average. This is real life example that I think is worth kind of sharing. So let's kind of back up a little bit. Why is investing critical? Well, especially in markets like today, and actually going back many years, the average rate that you get by just putting money into a credit union or a bank, kind of checking account is pretty minimal at this point. And even if you look at things like bonds, which are essentially kind of IOUs that companies or governments give, even if you adjust for inflation, the return is pretty low. You look at the inflation rate from 2019, it's 1.8%, meaning that if you had put money into a checking account, you wouldn't even be making up for inflation. The only thing that has consistently, kind of beaten inflation, but also really helped you to grow your money over time is investing in kind of the stock market in equities. Another way of putting this is if you had invested $1,000 back in 1915 and you invested it $1,000 in bonds and $1,000 in stocks, where would your money be in 2014? You can see that if you had put it into bonds, you'd be making about a 3x return. You'd have about $3,000. whereas $1,000 in stocks would have been worth $2.3 million in 2014. So in terms of actually growing your wealth and doing it in a substantial way, stocks and bonds are both play a role, but stocks are going to really catalyze a lot of the returns that you get. So let's dig in a little bit on this, and let me give one more kind of question. Some of you who are more analytically inclined will probably get this right. Imagine you are walking down the street one day and you pick up a magic penny. And this penny is magical because it doubles in value every single day. So on day 2, you have 2 cents, 4 cents, 8 cents, 16 cents, etc. How much money do you think you'll have on day 31? Let me just go to my other poll question here. Launch this. How much money do you think you'll have on day 31 if you're starting with a penny and it's doubling every single day? Some of you are maybe using a calculator, some of you maybe in Excel. Don't worry, there's no shame in getting this right or wrong. I'll give you a few more seconds, and then we'll share the results. All right. Okay. Very interesting. I'll give people 5 more seconds. Okay. Let me share the results. So almost half of you think that you'd have about $10,000. The next, kind of most popular answer was 10 million, and then kind of a split between some of the other answers there. So the answer for those who put it was around $10 million. So 1 penny grows to 10.7 to be, 10.7 million to be accurate in 31 days. That is a lot of money. Now, a couple more thought experiments, and I'll let you just think this through. What if you missed the penny on day 1? You were busy walking down the street and maybe you were on your phone, checking Instagram or texting. You missed the penny and you only got it on day 2. How much money do you think you'd have? I'll let you think that through. I'll give you the answer, which is half, $5.3 million. Last part of the thought experiment, imagine you missed the penny for the first 10 days and you only picked it up essentially on day 10. How much money do you think you'd have? Well, 10.7 million is great, 5.3 million, also a lot of money. All of a sudden you go to $20,000, quite a big difference. So a couple of things here. One, anybody that claims that they can double your money in a day or even in a year, I would go back to that first point around, what's in it for them? Nobody's been able to do that consistently over time, kind of year in and year out. But the beauty here is this is really something called the time value of money, or you may have heard this as explained as the power of compound interest. Really talking about how small amounts can start to grow and snowball and really grow exponentially because of the power of compounding. And you can see here that, essentially the doubling of money in absolute terms starts really small, right? You're only adding 8 cents, 16 cents. The real doublings that matter are the ones at the end when you're adding $2.6 million, $5.3 million. And it's these last doublings that are the most important from an absolute dollar perspective. The key insight, though, is that in order to get to those last doublings, you have to start early. If you started on day 2, you got to $5.3 million. That's great. But if you had started a day earlier, you would have twice as much money. So really the point I'm trying to make here and illustrate through this is that the earlier you can start to invest, the better off you'll be. And kind of the inverse of that is if you delay starting to invest, it can have a lot of consequences. If you delayed, in this case, 10 days or 10 years, you can see how much less you'd have at the end of the same time period. Or to put it another way, you'd have to invest so much more just to catch up. So this I just like to use to kind of show the importance of starting to kind of think early, and how even small amounts, knowing that many of you may be on kind of smaller budgets than you will be in the future, can really still add up over time. And it's not just the amount that you're investing in the market, but the time in market that you give your money to essentially grow. So key takeaway number 1, start saving early and start saving as consistently as possible. And I'll show you some fun experiments that were done that basically will give you some good ways to save consistently. So let's jump in, and these are some of the themes that I'll cover over the next hour. Talking about investing versus saving. Why do I view the two differently? Time horizon and risk level, how to align with your goals, and then thinking about whether you should do this alone or get help in some form. So before you start to invest, there are some things that I think are really important to take care of as foundational elements. Number one, really important that you start to build up an emergency fund. Usually people say 3 to 6 months of your expenses that you want to save. Think of this as a stuff happens fund. For some reason, you kind of lose a job, you have sudden and high healthcare expenses. If you own a car, the car breaks down, you need to make a big repair or a purchase. If you own a home or an apartment, the boiler breaks, things like that. Basically, you want to put money away so that you have a buffer to absorb any unexpected shocks that come your way. That money, probably best to put it in a very liquid account, ideally a checking or savings account, and keep it separate from the rest of your money. You don't want to be tempted to withdraw that money, for a non-emergency, if you will. Number two is making sure that you're paying off high interest debt, especially credit cards. Investing on average over time, you saw in the previous slide, if you go back 100 years, about 8%, yearly. That's probably even coming down in the last couple of years, or forecasted to even come down further in the next few decades. If you have credit card debt that you're not paying off every month, you are probably paying at least 11, if not 15 or 25% on it. And you are much better off paying off that debt than putting money away on the investing side. And finally, I think, if you do have an employer match on retirement, we'll talk about that at the next session. Those are things that you want to kind of contribute to a retirement plan before you start to think about general investing. So I always like to kind of start by just differentiating there, because everyone loves to jump in and talk about investing. It's the sexy thing. It's how do I essentially get rich? How do I really grow my wealth? It's an important part of your overall financial plan, but you want to make sure that you have some other basic aspects covered first. So let's start with some terminology. I'm not going to drain these, but I put on the left, and you'll have access to these slides afterwards, but some kind of key components or different financial instruments that you may come across, ranging from a checking or savings account, a money market account, bonds, which I mentioned are kind of an IOU, stocks, which essentially give you ownership in a company. So if you own a share of Apple, you actually own a piece, albeit a very, 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 very small piece of Apple. And then mutual funds are essentially a collection of either stocks or bonds that somebody else has already put together. So these are just some terms that I want you to kind of keep in the back of your mind. Now, the reason I talk about these is you want to think about risk and the investment choices that you're making. The items that I put before can essentially be translated into a spectrum of risk, going from the lower end where you have checking and savings account, all the way to the high end where I have stocks and probably things that I didn't even put on here, like cryptocurrencies. Checking and savings account, if you're under the FDIC limit of $250,000 per account, you essentially have virtually zero risk in the money that you put in there. The implication though is that you're probably not earning a lot. If you saw the average rates I put on the screen before, the reward is pretty low. If you start going up into bonds and stocks, you're starting to take on either a little bit or more risk. And then mutual funds I kind of put in the middle because they're a bit more diversified. So when you think about what you're investing in, you want to think about your investment choices and the risk that's associated with it. But that's not the only dimension that you need to think about. The other one is thinking about your time horizon. Essentially, how long are you investing for? You may be investing for the short term. Maybe you are saving for a down payment for a apartment that you want to buy in 5 or 7 years. That would be a shorter term than, let's say, if you're saving for retirement, which is one of the longer term items that people have. The reason it's really important to define your time horizon is that ultimately you want to make sure that you are aligning the amount of risk you're taking with the time horizon. The longer the time horizon, the more risk you can afford to take. And if you go back to here, the longer time horizon you have, the more risky items, whether it's mutual funds or stocks, you probably want to have in your portfolio. If you are saving for something in the next year, I would argue that your time horizon is short and you should take almost no risk or virtually no risk with what you're investing in. And I would keep it more on the checking savings account. Medium term, you can start to take a little bit more risk and diversify. And if you're in your 20s or 30s and you're saving for retirement that's in 30 or 40 years, I would argue that the majority of your portfolio should be in riskier items like stocks. And let me show you why I kind of give those rules of thumb. Imagine over kind of the past relatively 100 years, if you had invested $1,000 in stocks, what I think of as riskier, and you invested them for just one single year. If you were in a good year, your $1,000 would be up 53% at the end of the year. And you'd have $1,500 plus. But if it was one of the bad years or the worst year, you could be down almost 27% and you'd have $750, if you will, or $770. So if you need the money right away, you may not want to take that much risk because stocks are very, very volatile in the short term. You could be up a lot, but imagine you were saving for a down payment on an apartment and you needed $10,000. You invested it all in stocks and all of a sudden you only had $7,700. You may not be able to afford that down payment anymore. Let's go to a longer time period. Imagine you invested that same $1,000 and you are now looking at a 25-year time frame in the past 100 years. So let's say you were looking at 1950 to 1975 or 1960 to 1985, any 25-year time period over the past 100 years. If you picked the best 25-year time period, you would be up 11% annually over that time. So your money would grow quite a bit. Now, the worst 25-year time frame might surprise you. You'd still be up 8% annually in your return. So what's happening here? This is the same view in a graphical format. And this was looking through, kind of through 1994. You can see a couple of things here. One is that as you go out from a 1 to 5, 10, 15, 25-year time frame, two things are happening. The delta between the maximum amount that was returned versus the minimum amount starts to shrink. Here you have about, 78 kind of percentage point difference. When you go to 15 years, you're only talking about a 12% difference. And here when you look at a 25-year time frame, you're only looking at a 3% difference. The second thing you'll notice is that the worst outcome that you could possibly have starts to look a lot better. 1 year time frame, you could lose a quarter of your money. On a 5-year time frame, you could still be losing money. But as you start getting into 10, 15, 20, and 25-year ranges, you see that the worst that you can do is still to make money. Now, yes, you could make a little bit or more, but you'll see that over the long run, stocks have much lower volatility than they do over the short run, which is why I go back to my point before, which is if you're saving for something that's a longer time horizon, you can afford to put more of your money in riskier assets like stocks because you will most likely be making money. And even if you're not making a ton, you're still making a little bit. So just a kind of a graphical representation of that point. Now, I love to use 2020 as a more recent example of this to kind of show what could happen. 2020 started, the S&P was at 3,200 and it actually was up 4% by mid-February. And as we all know, COVID hit and the market actually dropped by close to 50% in less than or about a month's time frame between February and kind of the end of March. If you had put money in and you needed money right away, you would have to absorb a huge, huge loss just to take your money out at that point. You can see that by April, some of it had recovered, but you'd still be down. And actually by the end of 2020 actually was a banner year. If you had kept your money in all year, you were actually up 13% over time. So, people often look and say, a couple of things. One is, I'll take the risk. Last year was a great example, completely unexpected, of how your money can kind of really go down in the short term. The other piece I'll call out here is, I think it's really important to think about where it is that you're actually opening up accounts. I kind of knocked a little bit of GameStop at the start, and I will, go out on a soapbox and say that I would highly, highly recommend that none of you download or use Robinhood. I think of Robinhood as more gambling as opposed to investing. It really gets you addicted. It gives you access to very sophisticated kind of mechanisms to trade, which most people don't need and frankly don't understand. I would steer you toward highly reputable investment management companies like a Vanguard or a Fidelity. These are not the only two good options. There's many others like BlackRock, Charles Schwab, I think is quite good. And I'll talk about what you should look. And I also call out others that are the Robo Advisors that many of you have heard about, like a Betterment or a Wealthfront. Those are also very good. Betterment actually has all, if not most of its investments as low-cost kind of Vanguard funds. So I just wanted to kind of cover that a little bit here because to me, when I talk about where to invest, it's not the Robinhood gambling type investments. It's thinking about slow and steady and kind of the average type of investments. So one question that's come up in a lot of my past sessions, and my understanding is that probably a fair mix of kind of U.S. versus international students is who can open an account. So if you are a U.S. citizen, or essentially if you have a Social Security number or an ITIN, individual tax identification number, you'll be able to open an account at a Vanguard or a Fidelity. I will say that some, and Vanguard and Fidelity are a bit stricter, some only will accept a Social Security number. They won't accept an ITIN number. But a lot of others, if you call in on online brokerages or others, you will be able to open an account with an ITIN. If you are kind of a PhD student, for most of you, you should be able to apply and receive a Social Security number. Whether you're on an F1, kind of a J1, there's different, kind of different criteria. You can easily kind of Google, or I'm sure the international, usually the International Students Association or kind of office has details. But, for many kind of grad students or kind of PhDs who are international, you should still be able to get a Social Security number. And that's really the key for opening up an account. These investment management firms have an obligation not only to screen you to make sure that they know who you are, they also have an obligation to report, kind of tax implications in terms of gains to the government. And so that's why they require that SSN in addition to kind of other information. But it's a question that often comes up. I am an international student. I'm a resident, kind of alien, to use the IRS terms. Can I still open up an account? And this hopefully answers a little bit of that. The other piece to take from the COVID example, and frankly from a lot of others, is that you shouldn't try to time the market. And oftentimes it backfires. This is kind of showing a little bit of the annualized performance for people who either were fully invested over time between 2000 and 2019, and those who missed some of the best trading days. And you can see that those who missed more than 20 kind of the best trading days lost money over the 19-year time frame. And if you had invested $10,000 in the year 2000, if you were fully invested, you would be up in kind of the S&P, you would be at about 32,000. But if you missed even the 10 best trading days, you would be at half of that. Why is this important? Let me go back to my COVID example. It's really hard to know when those best trading days are. In fact, many of the best trading days follow some of the worst trading days. And you can see that here in terms of how the market is plummeting and then shooting up. You see the slope of these lines really, really steep. Did you know, and would you be able to kind of tell that, yes, of course, in retrospect, everyone should have bought right here, but hard to tell. Would you be able to stomach saying, I'm going to buy in at this point? Probably not. It's really, really hard to time the market. And most people, when they try to, miss out on some of those best trading days. So highly advised, slow and steady wins the race. Invest just on a consistent kind of basis all the time. So let me start to get a bit more specific on some of these. What to invest in when you're investing for the medium and the long term? I would recommend that philosophy that Warren Buffett espouses of being average. To me, I would ignore most individual stocks and focus on mutual funds or exchange traded funds, which are just an electronic version of mutual funds. The reason is they help you diversify automatically. You don't have to spend a lot of your precious time researching individual companies. A lot of times, if you want to invest in a specific company, you'll want to do research before you buy the stock, and then you have to monitor on an ongoing basis to know when you should sell. With mutual funds and ETFs, you don't have to do that. And oftentimes they have lower costs. My advice, focus the vast majority, if not all of your portfolio on mutual funds and ETFs. If you really want, leave a small portion to play the market, if you will. But I would call that actually more of the gambling side and look at it as play money. Don't put the vast majority of your investments in individual stocks. So when you're looking for a mutual fund, my advice is to focus on these average funds, and these are the index funds. These are mainly meant to track the market. You don't have to worry about kind of doing it yourself, and you don't even have individuals who are picking individual stocks. The result is the costs are much, much lower. Not as good are what we call actively managed funds. These are ones where you do have individuals who are picking stocks and trading, and because of that, they often have a much higher cost. So in general, that's going to be my advice. I'll give you a couple specific examples of why I say this. This is from a great New York Times article that basically looked at actively managed funds that claim that they could, beat the market. And they started in 2010, and they looked at 2,600 funds that had outperformed, the market that year. And then they basically looked at how many of those funds continued to outperform the market in each of the following years. And you can see that by the end of the kind of 5-year time frame, only 2 of those funds had consistently beaten the market. So this is like flipping a coin. If I asked all of you to flip a coin 20 times, there may very well be one of you that flipped heads on each of those times. Would we be willing to bet on that person, and give them $1 million, on the next flip to think that it's going to be heads, or is it a 50-50 chance? So again, I think that's a little bit of the recommendation and a little bit of kind of a study there, and I'll show you another one in a minute. I did have a question that came in asking about my thoughts on ETFs that track the market versus ones that track specific sectors. So there are mutual funds and ETFs that basically track the market as a whole, and there are ones that are basically carving out a specific industry or kind of sector, like the energy sector, or high tech, fintech, communications, metals within there. In general, I like to keep it simple and really focus on ETFs or mutual funds that track the market. I think it's just easier to kind of manage my own portfolio. I think ETFs that track specific sectors can form a good part of your portfolio. Oftentimes they are a bit more expensive. And I think you're starting to then have to kind of think about more time and kind of energy in terms of how you're kind of managing your overall portfolio. So I prefer to kind of keep it simple and keep it pretty kind of pretty basic with that. One other question that came in, let me address that, and then we'll kind of keep going. So essentially, a question came in: what does it mean to research a company? I hear it a lot. Does it mean to track what they're working on? Researching a company, essentially, when you're buying, when you want to buy a stock, you want to make an investment of buying something that you think is going to go up in value. So essentially, it's kind of making a bet on the company, and essentially saying that I think that company is going to grow and probably grow more than the consensus or than kind of Wall Street and analysts think. So when it's researching a company, basically you have to make a determination on which companies you think are currently undervalued or have potential to grow. So researching a company can involve a lot of different things. It can involve reading through their financials, conducting kind of a competitive assessment of the industry and kind of the sector they're in. Could actually go out and be interviewing clients or interviewing a lot of people. Researching is essentially trying to form a point of view about whether the stock is a good one to buy or not. So I focus a lot on simplicity and on focusing you on average, low cost kind of index funds. Morningstar is a company that rates funds, and they did some research looking at their star ratings and also looking at kind of what were some of the best predictors of of success. And I won't drink this for all of you, but essentially what they found is that you improve your odds of success by favoring inexpensive, low-cost funds, and that the odds of success with higher cost funds generally decrease over longer periods of time. So just another kind of aspect, I know we have a lot of folks who are more into kind of research, just a little bit more kind of evidence of the focus on low cost funds. So I gave you some evidence. Let me actually turn it over to stop sharing here. Turn over to John Oliver just to provide slightly different evidence of that. Let me just share my screen differently. Here we go. Just in case you want to be convinced by a different option. Okay, I'll go full screen.
Compound interest works both ways, meaning while your money adds up, your fees can really add up too.
Assume you're invested in a fund that is earning a gross annual return of...
Just going to make the volume a little bit higher, sorry.
7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. You've lost almost 2/3 of what you would have had.
2/3 of what you would have had is gone. So think of fees like termites. They're tiny, they're barely noticeable, and they can eat away your f***ing future. And one place where your 401k can be full of termites is the funds themselves. Generally speaking, you can choose between low-fee index funds, which basically just try to match the average returns of the stock market, or for a higher fee, you can get an actively managed fund with experts who will pick and choose stocks for you, trying to beat the market. And companies that sell active funds really believe in themselves.
At MFS Investment Management, we believe active management can protect capital long-term. Active management can take calculated risks. Active management can seek to outperform. Because active investment management isn't reactive, it's active.
Okay. That's not so much a coherent commercial as it is a drinking game where you do a shot every time he says the word active. But the problem with active management is that even many Wall Street experts find it difficult to consistently beat the market. And there is sometimes embarrassing evidence of this, like when a group of professionals were pitted in a stock-picking challenge against a cat named Orlando.
Orlando's method, he throws a toy mouse at a grid of companies, very scientific. Last year, Orlando's picks returned nearly 11%, while the pros had gained just 3.5%.
Oh my God! Let's all agree that The Wolf of Wall Street would have been way better starring that cat.
All right, let me reshare. So look, I try to come at you from different angles. Sometimes I think comedy is a great way, and I think John Oliver is actually very, very persuasive. So
Of course, instead of...
let me get out of this. Apologies. So again, all trying to reinforce the basic point of really your best bet is focusing in on very low cost investments. Let me just jump in. One question that came up is, okay, like what do I mean by low cost? Like what's a good way to do it? So for investments, oftentimes when you're investing in mutual funds, the way you know the cost is through something called an expense ratio. It basically tells you for a given amount of money, $1,000 that you put in, how much are you going to pay? And expense ratios are either in percentages or sometimes referred to as BIPs or basis points. So 100 basis points is 1%. So you may see that that a fund has an expense ratio of 0.5% or 1% or 0.1%. So when I talk low cost, in general, I want you to focus on things that are below 0.5%. When you look at kind of ETFs and some of the really kind of very passive investments, oftentimes those can even go to 0.04%. But anything that's 0.1%, 0.2%, 0.3% is actually fairly good. And somebody asked a question specifically around should one steer clear of low-cost mutual funds like some of Vanguard's retirement funds with expense ratios around 0.2%. To me, 0.2% is actually a pretty good expense ratio. When you're talking about actively managed funds, those are often above 1% and can even get up to 1.5%, 2%. So 0.2% is actually fairly good. And Vanguard's funds that have that, I'll talk a little bit about that a little bit later on. The ones that charge 0.2 for Vanguard, that's actually on the higher side. They do it for a very specific reason, which I'll get into a little bit later. So a little bit on asset allocation. How do you decide how much to have in stock-based mutual funds versus bond-based mutual funds? Stocks over time have always outperformed in the long run. And so the longer your time horizon, the more you want to be weighted towards, towards stocks. Now, bonds help to smooth out risk and basically create more stability in your portfolio. So the shorter your time horizon becomes, the more you want your portfolio to be weighted towards bonds. Some rules of thumb that people have often said is if you take 110 or 120, subtract your age, that's how much you should have in stocks, and the rest should be in bonds. So if you're 30, that would mean having between 80 and 90% of your portfolio in stocks and the rest in bonds. Right now, the bond market is returning very, very low amounts. So there are even advisors that will say, if your time horizon is really long, don't put more than 1 or 2% in bonds. But essentially the rule of thumb is the closer you are to meeting your money, the more conservative you should be, and the more of your money should be focused in on on stocks and bonds. Couple questions came in. Let me take those one. So, which one is better to open? Where is it basically better to open an account for investing? A credit union or a bank? Some credit unions and banks do offer investments. Most of them often focus on kind of other types of vehicles like savings accounts, checking accounts, or kind of loans. My advice would stay pretty consistent, which is I would look, I would avoid kind of banks because I've seen them charge really higher kind of expense ratios. I would focus in much more on kind of the large reputable investment management firms like a Vanguard or a Fidelity. So this is one point. We'll cover this a lot more in the retirement piece, but just to give you a sense of another option, and this gets to my point on the Vanguard 0.2% fees. You may see some types of funds. They're called target date funds or life cycle funds. Basically, what these are trying to do is these are used mainly for retirement. They basically say, like, what's the target date of your retirement? Let's say you're planning to retire in 40 years. So maybe they have a target date fund of 2060. And what that fund will do is automatically adjust the weighting of stocks and bonds to align with the time horizon. So you can see here stylistically, when you're far from retirement or like now, it's much more weighted towards stocks. And as you get closer to retirement, it weights you more towards bonds. This is the same principle that you should think of doing on your own potentially in terms of, reallocating money. The other point I want to make is shorter time horizon doesn't mean 100% pendulum swing to bonds. You still want to have some exposure to stocks because you're still, ideally wanting to benefit from those higher returns. So target date funds are kind of a one-stop shop that allow you to outsource all of the, allocation. Because of that, they generally charge a little bit more money. And that's where you'll see, even Vanguard target date funds having slightly higher, costs than, some of their individual funds. But even for them, I think the costs are still pretty low for these types of funds. One point to emphasize is that the majority of investors, especially US ones, are underexposed and under-indexed to international stocks. A lot of them will say, oh, great, I'll just invest in the US, what I know. Vanguard did a lot of research on this, and their kind of conclusion was that anywhere between 20 and 40% of kind of allocation of whatever you're putting in stocks towards international is actually kind of a good amount. And I won't bore you with some of the other details on here, but remember that when you're creating a portfolio, it's not just US stocks. It's actually thinking about international ones as well. This is a sample portfolio that I just mocked up. You can see that it has 60% in US stocks, 20% in small companies, 40% in large companies, and I have 25% international in both developed stocks and emerging market stocks. And 10% is other. Maybe that's bonds, maybe that's something else. One point I want to make is that there's no one right answer. These are portfolios and kind of given by a lot of really, really smart kind of people who've studied a lot of this. And you can see that they're all different. They're different in terms of the recommendations they make, and they're different in terms of the number of types of investments that are in there and how they allocate those. Some have 3 different allocations, some have 8, 9, 10 allocations. There is no right answer. I want to give you a couple kind of very specific kind of recommendations. And again, this is stylistic and illustrative. It's not meant as advice. But if you want to keep it simple, what you could say, let's say you're trying to save for retirement and you therefore have a long time horizon, you may create a portfolio that's 90% balanced towards stocks, 10% towards bonds. And this is one that I kind of allocate, which is 55% US, apologies on the typo there, 35% international, 10% bonds. If you're looking for very specific recommendations on how to create a portfolio like this, that's very simple. I gave kind of recommendations using both Vanguard and Fidelity. And you can see if you basically go in, and I'll show you, kind of the opening of the account, you would open an account, you would fund it, and then you could basically buy, kind of these 3 different types of mutual funds at Vanguard or Fidelity. You could probably do the same at any of the other ones that I mentioned, like a BlackRock or Charles Schwab. But you can see here that for Vanguard, they have a total stock market index fund, low cost. This is the ticker for it. This would essentially be the 55%. They have a total international stock index fund, again, index passive, low cost. Here's the ticker for the 35%. And then a total bond fund, and here's the ticker. So, we're kind of starting to get much more specific. And again, this is just an illustrative piece. Vanguard has a lot of other investments, Fidelity does as well. But if you're looking for a simple 3-fund portfolio as opposed to the 8, 9, 10 here, and you have a long time horizon until retirement, you could easily build a portfolio using only 3 mutual funds. And these are 2 examples of the ones that that may work out well for you. So if you're asking me, okay, great, this is all theory, what do I actually do? I use Vanguard just again as a stylistic example. If you go onto the Vanguard site, you would click on open an account, and then you would get a pop-up saying, how are you going to fund this? Ideally, you're probably going to transfer money from a bank. Eventually you do that, then you get to pick the type of account that you want. In this case, maybe it's a general investing account. If you are thinking about saving for retirement, you could click that option. There's others. Maybe you want to save for college tuition for for your son or daughter, or maybe you have some other plans. You can click those, and we'll go into detail on the retirement plans next week. So in this case, let's say you want to select the general investing account. You would select that, and then it would basically say, okay, pick the stock, pick the mutual funds that you want. You want the money that you're putting in to buy. And that's where you would actually have to go in and think through what are the different types of options that you want. Now, one of the points I made at the start was that it's important to save early and also to save consistently. The best recommendation that I can give you is to automate as much of your investing as possible. Instead of manually transferring money every month or a couple times a year, set up an automatic transfer from your checking account or your savings account to your investing account to kind of purchase more. It removes any of the headache of having to remember to do it. It's a really seamless way to do it, especially because this is kind of a graduate, postdoc, PhD crowd. I love to kind of give a couple academic studies that I think help to prove this. And most of mine involve kind of food. And this is one around chocolate cake versus fruit salad. It's a study that was done a while back. I think this one was out of Stanford. But basically, subjects came in and had to move from one room to another and remember either a 2 or a 7-digit number as they walked from one room to the next. And then they were given a choice between a piece of cake or a fruit salad. Those who had to remember a 2-digit number, 41% chose cake, the majority chose fruit salad. Those that had to remember a 7-digit number, a lot more chose cake. The conclusion that the researchers came to is that the higher the cognitive burden or load, the more likely people are to make less healthy choices, if you will. And translate this to a financial sense. You are all very, very busy. Cognitive load is at least 7 digits, if not 70 or 700. The more you can reduce the cognitive load, the more likely you are to make financially healthy decisions, like investing as opposed to going out and spending the money or splurging. And so, automation is a great way of helping to essentially reduce or kind of offset the cognitive burden that I'm sure many of us experience all the time. And it makes it less tempting to pick the less healthy options, if you will. That's one. Another one, this is really a famous kind of study in the field of behavioral economics. I'll relate it to financials in a second. This was done by Eric Johnson and a few others out of Columbia. They basically looked at the consent rates for organ donations. And when they plotted the rates in Europe, they noticed an interesting kind of difference. There were some countries in gold that had relatively low rates of consent for organ donation. And then there were a lot that had really high, almost 100% rates for organ donation in terms of consent. And what they noticed is, let's say you take Germany and Austria. These are geographically proximate, very similar culturally in terms of values. Why is it that these two countries who are very close to each other and are almost identical, not quite, have such differences? And what they concluded was that Germany, or the ones in gold, had a default of opting in. In other words, the default was you're not donating your organs, and you had to explicitly give consent to donate your organs. Whereas in Austria, the default was we assume you consent, you have the right to opt out. So just the default in this case resulted in dramatically different consent rates. Now, everyone still had full freedom, regardless of the default, you could still move to the other kind of position. But what they found is that inertia is a really, really powerful force. Now, this has kind of taken shape in many ways when it comes to defaulting people into saving for retirement. But it also can be applied on an individual level when you're thinking about investing for anything. You essentially want to create the default through automation or something else of investing every single month. And essentially the default is money is going into your investing account. And then you always have the freedom to opt out. But you essentially want to create a situation where you're like Austria, and most of the time your money is going, kind of and you're saving for, you're saving for your goals and investing money. So question also comes in around what else could you automate and what other defaults can you save? Think about it. Maybe now you're saying, look, my budget's pretty tight. I can only put $50 away every month into an investing account. Well, can you automate it? Maybe as maybe your stipend as a PhD student goes up every year, or maybe, once you start working, you will start getting a yearly raise. Can you automate it so that when that yearly raise hits, your contribution rate towards your investing account goes up? There's a lot of different considerations here for things that you could do. I want to spend the last kind of few minutes here talking about whether you should go it alone or whether you should get advice from others. And so I mentioned Robo Advisors, and I think about the spectrum of advice going from do it alone to using a human advisor. In the middle is a new concept that's come up over the past couple of years around Robo Advisors, and they're essentially a hybrid of kind of going it alone and getting official help. And you'll see that there's now a spectrum of these. Betterment and Wealthfront are two of the more well-known ones. and then other companies like Vanguard and Charles Schwab have come out with their own options. Robo Advisors essentially use artificial intelligence to gauge your risk appetite, understand your goals, and then create a portfolio with the appropriate level of risk and automatically adjust it over time. So for example, and again, stylistically, this is just using Betterment as an example. If you were to open up a Betterment account, first thing they would ask you is, what's a goal that you're going for? Are you, saving for an emergency fund, safety net? Are you saving for retirement, general investing? And then they'll also ask you questions to try to gauge your risk appetite. And what they're trying to do is say, basically, how do we build a portfolio that's appropriate for this person, given their time horizon, their goal, and their risk appetite? So let's go through a couple of examples here. Let's say, somebody had put in a goal of a safety net, and they wanted to accumulate $10,000 in an emergency fund in 2 years. You see that even here, Betterment would advise a portfolio that's mainly weighted towards, cash and bonds, but still has a little bit of stocks, maybe a bit more aggressive than I would choose, but, helps. Now, go to this middle column. Let's say it's a major purchase. Maybe this person wants to save $100,000 for a down payment on a house in 5 years. You can see that with a longer time horizon, Betterment is suggesting a more aggressive, at least starting portfolio, that's almost 50-50 weighted from stocks towards kind of other instruments. And what Betterment would do is, in 1 or 2 years, it would automatically adjust this down just to reduce the exposure to stocks, not to zero, but it would start to adjust it down. Finally, let's say your parents funded your education and you want to pay that forward to your children, or you're just committed to sending them to school in the US where tuition is high, and you want to start saving for that. And let's say you're kind of about to have a child, or you just had a newborn. And let's say then the goal is to save $250,000 over the course of 18 years. You can see here with a much longer time horizon, Betterment is suggesting, starting with a portfolio that's 3/4 or more allocated towards stocks, and then automatically adjusting that down. Similarly, if now you can take more risk. If your son or daughter is about, in their senior year of high school and they're about to start, and you need to, start paying tuition, the percentage in stocks is probably going to be a lot lower because you don't want the volatility there. But just an example of kind of how Robo Advisors work. Now, Robo Advisors charge a fee for helping to kind of adjust your portfolio and give you some of the initial advice. In general, like Betterment charges about 0.25% or 0.35%, as a fee on top of what the mutual funds that you're investing in. That's a lot, but it's also a lot less than the 2% that a lot of human financial advisors would charge. So you kind of have to think about, do you need this? Are you willing to do it alone? Is this a better option for you than a human advisor? I will say Betterment and a lot of these others use very low cost index funds as the core of their portfolio. So they definitely espouse that Warren Buffett mentality. You are paying a slightly higher fee because there is a little bit of management of the portfolio, but it's a fraction of what you would pay to a human financial advisor. If you are going to use a human financial advisor, I want you to remember this one word, and that word is fiduciary. Fiduciary is a legal term. It basically means that this person has a duty of care. It's a legal duty to put your interests above anything else. And having a fiduciary duty means that that person is required to, think about you as number one person and give you recommendations that are in your best interest. Now, you may think, well, doesn't everyone give recommendations that are in a person's best interest? No. There are a lot of people who are financial advisors who are not fiduciaries. They're held to a lower standard, and many of them may have conflicts of interest, going back to one of my first points. There was a study done during the Obama administration looking at people who were giving financial advice who weren't fiduciaries. And what they found is that it cost Americans over $18 billion, with a B, $billion a year in kind of bad advice coming from individuals who weren't fiduciaries. Does being a fiduciary guarantee that you'll get good advice? No, there's still people who are fiduciaries who may still do the wrong thing. There's the Bernie Madoffs of the world, et cetera. but it's the least you can do to ensure that you are getting high quality advice. Another experiment, this was done by kind of a Harvard economist. He basically started people with a well-balanced portfolio using average index funds, and he sent them out in the Boston area to non-fiduciary financial advisors, and basically said, like, people went in and said, oh, here's my portfolio, what would you recommend? The majority of people of these non-fiduciary financial advisors recommended that people move from a very passive portfolio to actively managed funds that cost a lot more money. Probably not good advice in your interests. So again, a couple of different examples just to kind of showcase that there are a lot of people out there who can really help you with your money, who will give you really good financial advice. One of the best ways of finding them is to only focus on working with people who are fiduciaries. So I want to give a couple of suggested resources. We didn't, as I mentioned, we're only scratching the surface on some of these. If this has kind of piqued your interest in investing and learning more, some resources to think about. If you're inclined towards books, The Guide to Investing or The Millionaire Next Door, I think are fantastic. If you're more into newspapers and columns, I think Ron Lieber, Tara Siegel Bernard, and Carl Richards from the New York Times do a fantastic job of giving really good insights and kind of identifying potential pitfalls. Tara Siegel Bernard, for example, has a couple of columns on how to pick a financial advisor, questions that you want to ask, what do you want to think about. Carl Richards likes to really simplify a lot of kind of pieces down into very easy to understand and digestible nuggets. Others are the Bogleheads Forum. Bogleheads is a group of kind of fanatics named after John Bogle, who was the founder of Vanguard. They are all about low cost, passive index funds, average investments. And it's a great forum if you want to get much more detailed around specific sectors, how to make different investments. But most of the people on there live and breathe that Warren Buffett mentality. Blogs that I would recommend, I don't know, the fields that many of you are in. The Big Law Investor, or one that I put on here, it's the White Coat Investor, geared towards either lawyers or doctors. A lot of really great advice on investing. It's skewed a little bit towards professions, but not necessarily too much that people can't benefit from it. And a couple other resources there around kind of Her Money, which is by Jean Chatzky, which I think is a great resource. Finally, a question that comes up a lot is, if I am going to look for a financial advisor, do you have recommendations on where? Outside of Robo Advisors, there are two that I would recommend: looking at the XY Planning Network or going through NAPFA, which is the National Association of Personal Financial Advisors. The reason I recommend those two is all of the individuals you'll find on there are all fiduciaries, so check. And two, most of them work on a fee-only basis, meaning they will charge you to come in for a 1, 3, 5 time kind of visit to help you put together a plan and kind of think about your investments. They don't charge you the 1 or 2% every year of all of your investments to kind of manage those. So just some recommendations there. Let me just go. I saw a question come in. I'm going to save this question for the Q&A. I'll address it in a little bit. Let me kind of just come back and finish up here, and then we'll open it up. So that's the end of the kind of formal part. I'm going to leave the rest in a few extra minutes to kind of focus on Q&A. What I'd ask is, while we do the Q&A, and I'll type this into, let me see if I can send this to, let's see if I can actually send this to everyone. If I can send, okay. I'm just going to do this as an answer. Oops. I'm going to type this as an answer, everyone, but hopefully this will come through. I sent over a link to kind of just a quick survey, if you will. If you're able to just fill it out, just ask, what did you find helpful? What would you like to learn more about? As Debbie mentioned, we started this last year. We'd love to incorporate your feedback and kind of tweak this content to make sure it's relevant in the future. Think of it as a way to kind of pay forward, to your future classmates or kind of schoolmates. So if folks could kind of answer that, let me start to go through a few of the questions that came in, and feel free to keep typing. I'd love to kind of engage. So one person asked, I really care about what I'm investing in. For example, all my current investments are in renewable energy. How can I automate evaluating a portfolio that I curate, or when to look for new stocks to invest in? So look, this is a great point. I think especially over the past kind of 5-10 years, there's been a lot more kind of focus for many people around responsible investing, socially responsible investing, kind of, across different dimensions. And I think it's a really important thing to be able to talk about, because a lot of times you can have a voice and kind of have impact with where you're investing your money. And so, for a lot of people, this is going to be something I think that's going to become much more important and kind of a bigger part. And so, when you think about it, there are companies out there that actually can help in terms of creating a socially responsible investment portfolio. In this person's case, it says, all of your investments are in renewable energy. I would argue that that is probably a bit too, it's not as diversified as you could be. You're very concentrated in a specific sector, and even, and you're bearing a lot of risk just by focusing it in there. What I would, potentially recommend in a case like that is, can you find ways to only invest in things that you care about, but in a slightly more diversified way. So maybe it's only in socially responsible or kind of environmentally responsible companies or portfolios, but that are a bit more kind of sector agnostic, not just looking at let's say in this case renewable energy. That is going to be very hard to automate if you're kind of doing it on your own. The advice that I would have in a case like that is potentially looking to work with an investment management firm that has curated a socially responsible, environmentally responsible mutual fund or set of mutual funds. And that way, that kind of automates the process of, building out your portfolio, making sure that it's incorporating your values, which are extremely important and should be top of mind, in a way that's not exposing you to too much, concentrated financial risk. So, something there that I think I would recommend. Another question that came in, do you recommend managing student loans in the context of money management and investing? I may need you to follow up with a bit more specifics. The way I interpret it is potentially, how do you balance paying off student loans with investing? Is that the angle? So I'm going to answer that question. If that's not the angle, please feel free to follow up with a bit more detail and I can address that. A very common question that comes up is, how do you prioritize or think about paying off student loans versus saving for anything or investing? And usually it's in the context of saving for retirement. What I would say is this: there's no single answer that applies to everyone. But let me try to lay out a little bit of how I would think about it. In general, I think about it around the concept of, what is a better return on kind of your money. And so part of this is going to depend on, what rates your student loans are at and maybe how low can they go. The higher the rate on your student loans, the more likely I would be to recommend to you to pay those off before you really start to invest. Because again, you looked at kind of I showed you some of those rates early on where, you can expect to make on average 8% a year. If your loans are above 8% or near that, you'd rather take that as a guarantee. The lower the rate on your student loans, the less likely I would be to tell you to kind of pay those off very, very quickly. And maybe focus on splitting your money towards investing or saving for retirement. And partially because that's you could do much better by kind of putting them there. A couple of key caveats here. Investing is risky, right? The longer the time horizon, the more likely you are to make money. Whereas, so there is still some risk. Whereas when you pay off your student loans, you're locking in, that kind of payoff, and essentially, not having to pay the interest. So, for me, kind of looking at the interest rate is a big piece of it. The other piece is just thinking of it in terms of what is your current situation? How stable is it? Are you in a situation where you're going to stay at your job, or you see your salary increasing over time? Are you thinking about a career switch and maybe moving into something more risky? Maybe you want to start a company. That will also influence a little bit of your decision, right? Because if you are maybe really thinking about starting a company in a year or two, you may not want to have any debt, including student loans, hanging over your head. And so you may say, I'm actually going to prioritize paying off student loans. If you're thinking, you're in a pretty stable place, then, my recommendation is actually to focus more on, the investing side and saving for retirement specifically, versus, plowing additional funds into paying off student loans. But there is no, right answer there, but a little bit of the thought. I want to kind of touch on one other kind of tangential related question there, because part of determining the interest rate is also thinking, could I actually refinance my student loans to get the interest rate down? So a couple of thoughts on there. Refinancing is essentially having a private lender pay off your student loan and essentially, then take over kind of that loan. So you have to understand that it comes with kind of certain conditions. If you have federal student loans, you have a lot of protections: income-based repayments, public service loan forgiveness, deferment, forbearance. If you refinance, you give up those protections. Generally, refinancing allows you to lower the interest rate on your student loans, and you can do it actually quite a bit. I'll tell you, when I finished up business school, I had student loans at 6.8%. I refinanced those down to 2.5%, which made a huge difference for me. It saved me thousands of dollars a year. So refinancing has a lot of benefits, but you also have to make sure that you're comfortable giving up some of those benefits. And that can very much change the calculus also in terms of investing versus paying off loans. When I had my loans at 2.75%, or 2.5%, I was in no hurry to pay them off. I paid the minimum every single month, and all my extra money went into saving for retirement and saving, just investing in general, because I knew that over time I would get a much better return, than that. Couple additional specifics here. There is a moratorium on student loan interest until January. So if you're thinking about refinancing, probably don't want to do it at least until January. Beyond that, in order to refinance and get the best rates, you have to have really strong credit. And lenders will also look at, things like your debt to income ratio, how much money you're pulling in, et cetera. So you may be able to refinance while you're in grad school or kind of there, but you may also get much better rates a few years down the line, and you can refinance multiple times. But what I would say is that if you are thinking about refinancing, focus on shoring up your credit score and your credit, because the better your credit, the lower the rate that you'll get, and the more likelihood you will be to get accepted to refinance. So those are some guiding principles. I'm happy if you want to email me afterwards with your specific situation. I'm happy to opine a bit more specifically around how I think about the trade-off of student loans versus investing or saving for retirement. It's a great question, though. All right. If there are other questions, I'd love for folks to kind of bring those in. And please do, please do take a few minutes to kind of answer the survey. I'm gonna see if I can, I don't know if I can post the link in any other way, but let me see if other questions are coming in. Some people are asking, how much should I be investing? A couple of kind of thoughts on this. There's no hard and fast rule. When I do kind of my financial planning workshop, I usually tell people a couple of things. One is, overall, in terms of your saving plus investing, you want to aim for about 10 to 15% of your overall kind of income in a given year. And that's going towards emergency fund, paying off student loans, and also saving for retirement or investing. I think remember just the mantra, even if you're starting with small amounts, given while you're in school or kind of soon after, I'd rather you be putting away $10 a month or $25 a month into an account just to start out, and then working your way up from there as you're your salary increases, you get raises, bonuses, etc. There's really no amount that's too small. And frankly, I'd rather you start putting small amounts away early to really take advantage of that compounding, as opposed to kind of waiting until you're kind of more settled. So it's hard for me to give you an amount. It really depends on your your current situation. The other way to think about it, though, is think about the goals that you have, right? When I showed the betterment example, you want to work backwards from those goals to basically say, how much am I going to need? So let's say you want to buy a house in 5 years and you want a down payment of $10,000. You need, through whether it's saving and or investing, to be on track to be able to make that down payment. And so maybe that means savings wise putting away $2,000 a year to get to the $10,000 for 5 years, or it could mean maybe investing slightly less than $2,000 a year, just because that some of that money has a chance to grow. So the other way to think about it is start kind of from the end in mind. What are you saving or investing for? And use that as a way to kind of back into how much money you need to be putting away. And you can make certain assumptions and create, fancy scenarios saying, if I assume that I'm making 5% a year on my money, what does that mean for how much I need to invest? Versus maybe there's a downside case of, if I'm only making 3% a year, what does that mean? Or 7% a year. So you can kind of get as creative or kind of as detailed as you want with some of this, but for a lot of it, I would say, some is better than nothing, more is better than some, but also kind of work your way backwards through based on your goals and what you're trying to save for. All right. Any other questions for folks? I'll wait one more minute to see if anything else. Question came in: should I stick with the proportion of stocks you mentioned in a Roth IRA account? So we're going to go into a lot more detail on this next time, but a Roth IRA account is basically a very special type of retirement account. And for that account, my recommendation is, you want to start, if you're in your 20s or 30s, you want to be pretty aggressive with that. So money in your Roth IRA, as in any other retirement account, if you have a 30 or 40-year time horizon, I would be very, very aggressive on stocks, and specifically stock-based mutual funds or ETFs. I'll tell you, I'll put it this way: in my Roth account right now, I am, I think around probably between 85 and 90% weighted towards stock-based mutual funds. And you will want that to kind of decrease over time as you kind of, you get older and the time towards retirement shrinks. But for a Roth IRA, for a regular IRA, for a 401k, Roth 401k, if you're, with a 30 or 40-year time horizon, I would be very aggressive with what you put in your portfolio. If any of those terms, if those terms don't mean anything to you, highly recommend coming next week. We'll demystify kind of the alphabet soup of retirement accounts. But to answer this person's question, Roth IRA, I would stick to the exact same proportion, assuming that you have that long-term time horizon right now. It's a really good question. All right, great. I'll wait one more minute just to see if anything else comes in. Maybe folks are typing. Okay. All right, I don't see any others. So, if you do, please, I would really, really appreciate it if you are able to take a few minutes just to fill out that survey. I want to say thank you for coming and thank you for engaging, for the great questions. Really, really helpful. I will say, let me go back just to plug. We're going to do a lot more of these. So we have retirement coming up next time, and we have kind of taxes coming up in 2 weeks. So I hope you're able to join, and feel free to pass the word to kind of your colleagues as well. But thank you very much, and looking forward to hopefully seeing many of you next week as well.